depending on where you are. If any of you have been on a recent live stream, you know that we have struggled, to say the least, with the internet here because everyone's in quarantine in Colombia. So everyone's on the couch watching Netflix. So the bandwidth is very low. So that's why I've done it at a different time today. We're going to see if the internet is any better. Hopefully my audio is working. So guys, if you could quickly do me a favor in the live stream and let me know, A, if the audio is working, and B, if the video is working as well, or is it freezing, or does it seem pretty smooth? All right, feeling home real estate, everything is fine. Awesome, thank you. Yes, all is well. Seymour, thank you. Rick, thanks. Anthony, thanks. Okay, Benjamin, thank you. Shoot, choppy for David. Okay, looks like for most people it's pretty smooth. So let's just go into it. And I've got Sebastian on the phone right now. He's live. So we'll just we'll play it by feel, and we'll just keep moving forward with the live stream as long as we can, and hopefully it'll work. So like always, guys, if you want to ask a question, make sure that I see it. Do a super chat, and I've got Sebastian right on the phone with me here. Got my phone plugged in, and he'll let me know in real time. I'll answer that to the best of my ability. If you guys have a question that you'd just like to throw up in the chat stream, you'd want me to notice it, make sure that you start with question in all capital letters, because if we get quite a few people on, it moves so fast, I just can't see it. So little housekeeping before we get going here. If you guys have not taken the time to watch my interview with Chris McIntosh, former Wall Street insider, fund manager, it was absolutely amazing. It was definitely one of my favorites. All the comments, everyone's loving it. I'm getting tons and tons of really positive feedback because for the first maybe half hour of the interview, we really talk about the Fed and why the economy could potentially struggle and see stagflation on a moving forward basis. And then the last, call it half hour of the video, maybe 40 minutes, is all about Chris McIntosh giving us specific, industry actionable investment advice as far as not investment advice, but he's giving us an inside look as to what he is actually investing in right now in his fund for stagflation. And what's great about it is he's got a very similar worldview and investment philosophy to all of us, really, or most of us in the community. In other words, he likes gold, he likes Bitcoin, he does not like centralized power, not a big fan of the Fed, definitely doesn't like big government, but he likes to buy super cheap, unloved assets that have a lot of value with a ton of asymmetry. So make sure you check that out. We're also doing a promo that his people, kind of a deal that they gave listeners or viewers of the George Gammon channel, and you can check that out. I'll put a link in the description below the live stream, but if you go to that video, you'll see a link in the description below, and then we kind of announce it at the end of the video. But you guys are going to absolutely love it. So after this, make sure you do that. Next podcast, I want to remind everyone that we rip the audio from the live streams and the interviews. That goes to the Rebel Capitalist Show podcast. So if you're on Stitcher, iTunes, check that out. Leave us a review. It helps the algorithm, and I'd appreciate it. That's all I got to say on that. All right, the email list. If you guys haven't signed up for the email list, make sure you do that. I actually did probably like a 20-minute video that I did not, I uploaded it to YouTube, but it's unlisted. So the only way you can see it is if you're on the email list, because I shot it out on Thursday, Wednesday, Friday, something like that, where it's just totally raw, uncut, just me expressing and communicating my thoughts for about 20 or 30 minutes. Most people really, really enjoyed it. I'll continue to do that when we're on lockdown here, because it doesn't really add any work for my editors. So if you want to just get raw, unedited footage of me kind of just talking about what's on my mind and what I'm thinking about from a macro standpoint, then definitely sign up for the email list as soon as we're done. GeorgeGammon.com. There's pop-ups that are there. And most likely I'll do one again today. So you'll get some additional content that the people that are just subscribers to the YouTube channel will not see. Lastly, first I want to point out the fact that I really dislike both political parties. most of you know that well, that I'm hard on political candidates on the right. I'm hard on the people on the left. I don't discriminate. I dislike all politicians equally. But one thing that I'm seeing on my Twitter feed that's incredibly disturbing is a lot of these political pundits are coming out and saying the cerveza sickness is no big deal. It's the flu. It's all just the media trying to make sure Trump doesn't get reelected. And you shouldn't worry about it. It's just like a common cold. And this is all just a concoction of the media to scare you and to make sure that you don't go out of your house. So they're intentionally ruining the economy so Trump doesn't get reelected. This is nonsense. I mean, this is crazy talk. I cannot believe that anyone would have such a lack of ethics and morality to be willing to sacrifice people's health just to push a narrative that will most likely get them more ratings. It's disgusting, absolutely disgusting. So if you want to hear my full thoughts on how the way I'm looking at, the way I'm suggesting my family in the United States to look at this, check out my most recent podcast on QTR with Chris Irons, the Quote the Raven podcast. We went into it for like 2 hours, just nonstop, raw, uncut. So just a short Reader's Digest version is this is not the flu. I mean, now that said, it might not be as bad as some of the media outlets are claiming as far as the case fatality rate. It could be if we completely ignore it. And if we pretend that this is a common cold, then that's the danger. That's the danger. But I think this is something that we can keep under the curve as long as everyone is just being smart about it. So if you go outside, make sure you're wearing a face mask. Make sure you're wearing an N95 face mask. I bought like 500 of them 2 weeks ago to give to all my employees, the security guards at my building. Yes, you look like an idiot, granted, and it feels awkward the first few times. But what's your downside? What is your downside of wearing a face mask every time you go out if you're not on lockdown? Also, just try to stay home as much as you can. If I understand there's a balancing act with the economy. I totally get it. Totally get it. But if you can stay home, make sure you're doing that. Just avoid large gatherings. Wash your hands all the time. And just whether you feel as though this is just a really severe flu that could overwhelm the hospital system, or you think it's potentially something much more severe, the bottom line is just be smart about it. And if you hear anyone talking about this, trying to say that the cerveza sickness doesn't really exist and it's just a figment of our imagination and it's just a concoction of the media, you think China would shut down their entire economy because of a figment of their imagination? Or Italy? I mean, it's so ignorant, but they're just intentionally misleading people. And obviously you can tell I get really frustrated about it. So just pay attention to the facts, and the facts will tell you what you need to do. And that's just be smart, wear a mask if you're going outside, practice social distancing, wash your hands, and hopefully we can keep the curve down so we don't overwhelm the capacity of the hospital system. Okay, let's get into what you are all here for, and that is the economic talk, the Fed, how to invest, how to build wealth and thrive in a world of out of control central banks and big governments, right? Let's get into it. So first, super chat. Tony, thank you for the super chat. Rickard says it's against the Fifth Amendment to confiscate gold. Lynette Zhang talks about suit of armor or today's suit, 1 ounce of gold. If gold went up to 10,000, would a suit cost that much? Like wearing, like literally wearing clothing, like armor. I have not looked into that, Tony. That is definitely outside of the box thinking. I like it. What I have thought about is maybe doing jewelry that is as pure as possible. And I don't think, I actually did a video on this maybe a month ago or so. I couldn't find a case in history where a government confiscated jewelry that was made of gold, only just gold bullion. So I would, before you build a suit of armor made out of gold, I would probably start with maybe a bracelet or a necklace. I mean, I think if you walked on an airplane looking like Mr. T, I don't know, just say you're a rapper. They're not going to give you any problems, right? Maybe that's a great idea. Go undercover. So I'd probably start with the jewelry, Tony. David, thank you for the super chat. You've rocked it all week. What do you think about finding a way to short commercial real estate? Well, I appreciate your kind words, David. It's really a struggle for the whole team to continue to produce content, even though it's the makeshift whiteboard with everyone working at home and the internet being down and having all the technical issues. I mean, we're still having a lot of fun and we're still going to do it. But sometimes these, I can't remember which one last week, but because we had so many technical issues and internet issues, it literally took us 12 hours to do the video. 12 hours. It was like a marathon. That was the one that we posted really late. I think I probably posted like 10 or 11 p.m. Eastern time because it took us from 9 o'clock in the morning to actually finish it. It was just grueling. But I appreciate the kind words. So commercial real estate. Normally, I would say yes, because I think even on a moving forward basis, a lot fewer people are going to buy stuff at stores, even when the cerveza sickness is in the rear view mirror. And we will get through this. I mean, it's going to be a rough year, most likely. It's going to be hard. We're going to have to change our behavioral patterns, but we're going to get through it. And when we come out the other side, I just think you're going to see more people doing more things at home and kind of a behavioral shift. So obviously not bullish. That said, David, you've got to look at the 4-letter programs that the Fed has set up. I think the video I did on that was maybe Wednesday, but we're talking about the primary dealer credit facility, MILF, my favorite. What was was it TALF? I mean, there's so many of them. It's tough to keep them separate. But the bottom line, Mark, is I remember one of them gave the Fed the ability to buy mortgage-backed securities that instead of having residential loans, they were commercial loans and commercial real estate. So why would that prop up the market? Because now a bank knows that they can give a loan to anybody to buy this falling knife as far as the commercial real estate, and they don't have to keep that on their books. They can just sell it to Wall Street, and Wall Street can just quickly pawn it off on the Fed. And if the Fed doesn't have a profit and loss, which they don't, then if we're taking all of the commercial real estate debt, putting it onto the Fed's balance sheet, there is no downside for the issuer, the original issuer of that debt to give loans to everybody. It would be like subprime 2006 on steroids, because there's no downside for the loan originator. There's no downside for the Wall Street bank that packages it into an MBS or a CDO or whatever the hell they do with it. And it's just going straight to the Fed's balance sheet. The Fed is paying 100 cents on the dollar, 110 cents or whatever, and everyone's making profit, and the Fed takes all the risk. So I'd be careful shorting it. I think that's the best answer I can give you, David. That's kind of the both sides of the coin. And I think hopefully with that, you can better decide what's the most prudent decision for you and your finances and your portfolio on a moving forward basis. Mark, thank you for the super chat. George, I think you are a wizard. All righty then. Okay, Mark. I don't know if I'm a wizard. You guys have to keep in mind the editors make me look a lot smarter than I really am, but I appreciate your kind words. Just someone who almost flunked out of high school, just obsessive about macro, just trying to put the pieces of the puzzle together, and hopefully share that with everyone in the community. Okay, can you go over Chris's bullish case for coal from yesterday's video? Mark, you're letting the cat out of the bag. Mark, you're not supposed to do that, buddy. We got to tease it a little bit. We got to get all these people on the live stream that haven't seen it. We can't give them all the good stuff. We got to show them. We got to make them go to the video and watch it themselves. All right. Of course, I'm joking. So Chris had a bunch of amazing ideas. I had the editors put it in a list. So as he's going over, and keep in mind, these are just some of his ideas. If you look at his actual research, the newsletter that he sends out to his retail investor clients, it's just jam-packed with these ideas. We just went through, I think, 4 or 5. You'd have to look at the end there and see the list. But to go over your point, so coal. His main thesis is every time the entire world has never gone or let's see, how can I say this? The world has never gone to an energy source that's less dense. Right? So we've gone, let's say we go from wood to coal. We're going from an energy source that has a higher density. It has more energy per unit. We've never gone the other way. So if we go to electric or wind, I'm not saying that's good or bad. I'm just saying you're going the other direction. Also, he made the point that every time we go to a different energy source throughout human history, it doesn't eliminate the existing energy sources. And he used the example of wood and coal again. Just because we went from wood to coal, it doesn't mean we're not using wood anymore. It's just we may use it differently, but we're still using wood in a lot of areas around the world as an energy source. And if I'm not mistaken, in his research, he said that we're using just as much wood now as an energy source as we did when we transitioned from wood to coal. It makes sense because we've got a lot higher population. So that's where his idea starts. And from there, you just have to look at what's cheap. I know a lot of them went through, from my quick research, went through bankruptcy back in like 2016, 2017. So their balance sheets are pristine. I mean, almost zero debt. In fact, there's one company that he told me to look up that literally has zero debt. Zero. Like not $1 of debt. So that's tough to beat. And that was actually an Australian company. And I don't think you could, I think you have to have interactive brokers to buy it. or you have to be part of Chris's, like one of his managed accounts or something like that. But that's pretty much his thesis, and it's super cheap. I mean, you're getting these companies at way under a 10 PE. They're just printing money. They're flushed with cash, and they pay out a massive dividend. So why, do you ask? Because everyone's under the impression that every single politician is going to ban coal. We're going to move to green energy and do all these things. And that may be true in the United States, but there's still massive amounts of demand worldwide. Also, a lot of the coal is made for steel, not just burning and polluting the air. So another thing that I'd add to that, and this wasn't Chris's idea, but this was kind of my idea, which made me go pull the trigger. Just to be very, very clear, guys, I want to have full disclosure. I actually myself, I went out and bought the one of the coal ETFs that Chris told me about. It's the ticker is KOL, and I actually mentioned it briefly on Friday's whiteboard video. I kind of teased it a little bit, and I said that it was paying a 13% dividend. I was actually wrong. It's paying a 17% dividend because people think that they're just going to shut down these businesses, and maybe they will, but they still have all this demand outside of the United States. And a lot of the coal companies that are in the coal ETF, they're outside the US, so they might not have those restrictions. So you've got the worldwide population growing. When we get out of this next downturn, call it 2 years, we go into a worldwide global bear market, and the economies are contracting. But then you've got it going back up. And the bottom line right now is with coal, and this is my opinion, is you don't. I'm a firm believer that you make a lot more money with an investment when it goes from horrible to bad than when it goes from good to great. So right now, coal is horrible, but I don't think they're going to really go out of business because their balance sheets are pristine. Also, if we go through a year downturn with the cerveza sickness in the United States, or even longer, even if we get Biden in office, if we're going through a massive inflationary or any type of depression in the United States, is that really going to be a high priority for them, banning coal? I don't know. I doubt it. But I think that's basically my priority. I could go on for another hour, but I think you guys get it. So, so that's what I did. I'm really, really enjoying Chris's research. It's just awesome. And I love the fact that he's so like-minded. I mean, it's really, really cool. So you guys check out the video as soon as we get done. Andrew, thank you for the super chat. Do you think the squeeze in labor from self-isolation and visa slowdown will slow food exports and bump food prices? Like no imports from India. I do, Andrew. I'm not sure if you're talking about the United States specifically, but I think that there's going to be a lot less stuff actually produced, because even domestically in the US, because people are just staying at home. You've got the disruption of the global supply chains, but even where a lot of the supplies are being manufactured, if those people are staying home, they're first and foremost going to take care of themselves. So pharmaceuticals as an example, if we're getting the majority of our pharmaceuticals from India and they need XYZ drug, well, they're going to make sure that if they're creating a lot less of it, it's going to go to their people first. So yeah, I think we're going to have a lot less stuff in the United States, maybe not now, but probably in a month or so. That's going to put upward pressure on prices. At the same time, they're going to be doing MMT, sending a lot of people just checks in the mail, and they say they're doing that for 4 months. I doubt it. I think that's going to be a very, very politically difficult thing to reel that back in. I think you guys can just imagine if I mean 60-70% of the United States is getting a check for $1,200, and they kind of build their life around that. A family's getting checks for $3-4 grand, and they kind of get used to that. Who's going to vote for the guy that says, "Oh no, we need to stop this"? Right? Probably not going to happen. So I think it's going to be with us long term. At the very least, it's going to be with us every time that we come into a new problem, regardless of the severity. I don't know if most people have thought that through. So let's look at quantitative easing as an example. Well, when we first started doing QE, not we, the Fed, it was just very temporary. They called it extreme measures. We have to take extreme measures to save capitalism. Those were their words. Okay. Well, now, after 10, 12 years, QE isn't really extreme. In fact, the market goes down by 10%. And what do? Bam, QE. Okay. So in my opinion, moving forward, even if they do bring back the MMT or scale it back, next time we go through just a hiccup in the stock market, they're going to be bam, right back to MMT. And before long, in my opinion, it's going to be just like QE, just like the repo market, where the quote unquote temporary program becomes permanent. So I know that's a rant on a tangent there. Andrew, my point is there's going to be a lot more money chasing fewer goods and services. So I see an environment where the stuff you buy at the grocery store every day goes up in price, while at the same time, the assets are going down in price. Potentially the dollar is getting stronger relative to other currencies. So I really see a situation where every time you go to the store, your apples cost an extra 50 cents. But then you flip on the TV and you hear all the talking heads saying how strong the dollar is, and then also saying that we're going through deflation because the home values are going down, the stock market is going down, bond prices are going down, and the bottom line is you've got to look at inflation. You've got to compartmentalize inflation. Cody, thank you for the super chat. Really liking your material lately. Thank you. I appreciate it. Honestly, I was a little concerned because I know everyone's favorites are the whiteboard videos. So when we changed that to the makeshift whiteboard videos where I'm just kind of announcing it, I was kind of concerned with that people wouldn't like it. So I'm glad you guys enjoy it. That's awesome. Oh, wow. Okay. So Cody is saying that he's starting to, or she is starting to see more houses for sale in mid-Missouri recently. Was wondering if it would be smart to keep waiting before buying a rental property. I would say the same thing to you, Cody, that I've been telling people probably for the last couple weeks. And I've changed my tune here. Prior to the cerveza sickness, I was saying, listen, if the cash flow makes sense, go out there, buy something, make sure it's in a linear market, make sure you're getting fixed rate debt, because it's really about the cash flow and buying cheap debt. The asset is just kind of the way that you express that investment. Now, I think if you have a perfect there's no perfect property, but if you've got a property where the numbers really make sense, and I mean really make sense, let's call it a 1% RV ratio. You can lock in a super low interest rate for 30 years, fixed rate in a good neighborhood, something that really has the most likely will stay in high demand on a moving forward basis for the next, and I'm not just talking about through the cerveza sickness, but I'm talking about the next 10 years, the next 20 years in a good school district. I would go ahead and pull the trigger. If you don't have that awesome property right now, if you haven't seen one, I would not try to fit a round peg into a square hole. I would wait. I'd be very patient. I'd see where we are in 6 months. I'd keep looking, definitely keep looking, because you never know when you're going to find a super, super motivated buyer and get a smoking deal, like a 2012 type deal right now, even though the markets are inflated. So keep looking for sure. But that's how I would do it. I would be a lot more patient right now. Ike, thank you for the super chat. How to survive inevitable windfall tax on gold? Yeah. Thanks for the millions. Oh, thanks for the millions of dollars of education you have brought me. I've red pilled so many friends and family. That's cool, Ike. That's cool. Thank you for sharing my stuff. And I'm really happy to hear you're getting a lot of value from the content. And I know all the whole team, Sebastian, I'm seeing him in the chat right here, all the editors, the camera people, everyone involved. They really like to hear that they're making a difference. So I appreciate you communicating that. As far as attacks on gold, this is a very, very good point, Ike. Not only that, but we talk about gold going to 5,000 an ounce, 10,000 an ounce, $50,000 an ounce, but we never talk about or ask the question, is it going to go to 10,000 an ounce in nominal terms only? Or is it going to go to $10,000 an ounce adjusted for inflation? You have to ask that question. Because let's just say that gold went to $10,000 an ounce, but all it did was maintain your purchasing power from where it is today, call it 1,600. So in real terms, it really didn't go up. But you are being taxed on the nominal value. You're being taxed on the nominal delta difference between where you purchased and where you sell. You're not being taxed on the inflation adjusted profit or the inflation adjusted return. So you could have a situation where gold goes to $50,000 an ounce and you go to sell it and you actually have less purchasing power than you have right now. I'm not saying that's going to happen. I'm saying that it's a possibility that people really need to think through. So the solution, I think, would be to what is the solution? Sometimes these are difficult because I've got to think through this in real time. You guys ask some great questions. I think first and foremost, you got to be a long-term holder. If you're buying gold right now to just get rich quick and you want to just buy it now and unload it in a year when it's at $10,000 an ounce, I think you might get burned there from the standpoint of not that gold won't go up, but it might not go up in real terms and you got the tax hit. I think the way I buy gold is what I would suggest, and that's you look at it as insurance and just a way to maintain your wealth. It's not a way to get rich. It's a way to stay rich or just stay at whatever level of purchasing power you currently have. As long as you're looking at gold long term and as just a store of value and not a way to just 10x your purchasing power, then I think you're looking at it long term and you're going to do okay because you're never putting yourself into a position where you actually have to sell to increase your purchasing power or to sustain it. So I think first I'd look at it in those terms. I mean, you guys know what I do. Well, maybe you guys don't know what I do. In 2013, I remember 2012, 13, I forgot when it was. I moved my residency to Puerto Rico. I did it before Schiff. Schiff copied me. I'm joking, of course. But I did go there before Schiff, that's for sure. So I know that's not a realistic solution for everybody, but for those of you who have that option, think about it. Think about moving to a jurisdiction, and for Americans, it's only Puerto Rico. For Europeans, for Aussies, for people who live in pretty much any other country in the entire world, you can think about building your wealth right now in a time where there's going to be a lot of opportunity because of the transition that the whole entire world economy is going through because of the cerveza sickness. And a lot of people are going to build a lot of wealth. And then maybe moving your residency or physically going to a place that's just as nice, maybe as where you live now, but is a little bit more friendly to capital gains. And let me be very clear. I'm not saying that you should try to avoid paying tax. I'm saying that you should do what is required by the law. But maybe go somewhere where abiding by the law is going to allow you to pay a little bit less. And again, I know it's not a solution for everybody, but for those people who have the flexibility, I'd look into that. And then I just look at it as a long-term play to maintain your purchasing power. XRP, Bull on the Moon, thank you for the super chat. Could you do a video with at tow, the lifeboats on XRP and how it can solve the liquidity crisis today? It would be a great bridge between the current financial system and the future digital financial system, and has an army of followers. I'm not sure who that is. If you want to email maybe their Twitter handle to Sebastian, it's at georgegammon.contact@gmail.com. Maybe we can look it up. I'm not sure how Ripple would solve a liquidity issue, but I'm definitely open to understanding more. That's for sure. Geo Rob, thank you for the super chat. Thanks for the amazing content. Really enjoy your video with Chris McIntosh. Yes. Awesome, wasn't it? Loved his outside of the box investing. Oil tankers, gold or coal, great plays. Yes. Yes, Geo Rob. And if you didn't hear, I bought the coal ETF that he's actually, I don't know if Chris said that when we were recording or just when we were talking afterwards, because we talked about like another hour after we got done recording, just so you know. It might have been something he told me, but I bought coal, KOL. I'm not saying that that's investment advice. I'm just saying that's what I'm doing. And I'm also looking into the oil tankers on potentially buying them on Monday, because I really like that as well. And I kind of like it. I kind of like buying maybe like an oil producer, like a Shell or something, and then buying the oil tanker, because if oil goes down, technically the price of the oil tanker goes up. And if the price of oil goes up, then your Shell will most likely go up. And then if the price of oil goes way up in the future, then the oil tanker will go up. Both of them will rise. And when I say go up, you guys have to keep in mind, I'm not talking about the next 6 months. The dividend could completely go away. I totally get it. When I buy something like the coal stock that I bought Friday, I'll keep that for 10 years. I won't sell it. This isn't something where I'm like, okay, man, hopefully I can get an awesome pop. It'll double in 6 months. I'll sell it and woohoo. No, I'll keep it until it's expensive. And if it's not expensive, I won't sell it. And if it's not cheap, I won't buy it. Hopefully that helps. Anwar, thank you for the super chat. Anwar, I'm assuming you are in Singapore, one of my favorite places. I've spent much time there. Mind-blowing sessions with Chris and Brent. Yes, I totally agree. Both those guys are awesome. By the way, those guys are good buddies too. It's interesting how people kind of flock together like that are all on the same page. Are these good bets? UUP, USD. Okay, so UUP for long USD, coal for coal. Any way to go leverage? Oh, I wouldn't use leverage, Anwar. And I don't know, to answer your question. I don't know if there's a leverage way to go long the USD. But and that said, guys, I want to be clear. It's not my guess, or Anwar, I'm not going to put words in your mouth, but it's not like you're saying that we're not going to have price inflation. You're just saying against a basket of currencies, you might be bullish on the dollar. But I think next week I need to do a video with Luke Groman, and I'm going to maybe text him today and see if he's got some free time, just so we can get the counter argument as far as the dollar going up outside the United States against a basket of currencies, because you really need to weigh both. It's just like a court case. You don't want to listen to just the plaintiff or just the defendant. You want to listen to both arguments. So my point is, I wouldn't be confident enough one way or the other to use leverage. So, but that's totally up to you. As far as UUP, I would say yes. I have not looked into that myself, but when I asked Chris, and I think I did this when we weren't recording, I said, hey, what's the best way to play the dollar right now? Or how are you playing it with your managed funds? And that's what he said was UUP. Darren, thank you for the super chat. Love the straight talk. Great ideas. So happy I found you before the S storm. Darren, I appreciate it, buddy. Looks like you're up in Canada. Thank you for taking the time to watch. I really appreciate it. I know you guys could be doing 1,000 other things, even if you're quarantined and lockdown. So the fact that you guys take the time to watch some of the videos, and I know the videos have been really long lately too. It's weird. I try to do like a 10-minute video, and I just can't explain everything in 10 minutes. So I try to do it as fast as I can. But at the end, once I felt like I've finished my thought, and sometimes I don't even finish a thought, and we still just have to cut it short, and it's 25 minutes. So anyway, I understand the videos are really long, and the fact you guys are watching, I just sincerely appreciate, because I do value your time. Tony, thank you for the super chat. Really, George? Oh, okay. I see what you're saying. So he said, really, George, Lynette said in Roman times, a suit of armor cost 1 ounce of gold. Now a suit costs 1 ounce. Would 10,000 gold mean a suit would cost 10,000? Potentially, Tony, you're getting it. You're absolutely thinking about it the right way. We could have if gold just goes up in nominal terms, then yes, that same suit would cost $10,000. Gold absolutely could go up in real terms. I think it most likely will, but I don't think it'll like go up 10x in real terms. I hope I'm wrong. But so if it just goes up a little more, then you could have gold at 10,000 and that same suit at 5,000 or 8,000, right? So it's all relative to the price of existing goods and services. And that goes back to how much money or currency units, excuse me, I don't want to use the word money there because currency is not money. We all know that. So it goes back to how many currency units are chasing a specific good or service. And we can have this situation, and that's why I say compartmentalize inflation, because the Fed is creating all these currency units, or the Treasury, and they're injecting these units into the system. But those units aren't going to be chasing homes. They're most likely not going to be chasing high-end autos. They're most likely going to be chasing the stuff you buy on a daily basis. So hopefully that answers your question. And by the way, Tony, I've tried to I even in Friday's video, I was a little concerned that I was kind of beating a dead horse, because I think in pretty much every video I did and every interview I did last week where I was being interviewed by someone else, I was talking about how you have to compartmentalize inflation, and I'm still talking about it. So if any of you have heard me say that over and over and over again, I apologize, but the reason I'm doing that is because I think it's probably the biggest issue, or it's the hardest thing that people really have, or it's the hardest thing for people to get their minds around. So I'm trying to just repeat it over and over again so people understand it, because I think it's just vitally important on a moving forward basis. Walt, thank you for the super chat. Excuse me. I have 100 kilograms of silver and 2 kilograms of gold. How do I know when to buy real estate and shares? Deflation, hyperinflation triggers. How to price discovery in that time? Well, it goes back to just asking yourself, is it cheap? That's how you'll know. The time to buy real estate is when it's cheap. Or maybe you're buying the cash flow. Maybe you're buying the debt. Maybe you're buying a share of coal. Just when it's cheap, that's how you know. How do I determine if it's cheap? Excuse me. I'll just try to find a chart and go back as far as I possibly can on the chart and adjust it for inflation. So as an example, the macro trends, the website has a lot of really cool charts, because they've just got a little button where you can look at it in real terms or nominal terms. And they've got a lot of commodities. I know I've pulled up gold, oil. I think I looked up coal there as well. My memory serves me right. But I'm just going back, excuse me. I'm just going back as far as I can, like 1950s, 40s, 30s, and just seeing what the price was adjusted for inflation during all these times through stagflation in the 1970s, what it's been lately, what it did in 2008, 2009, how far the price went down, peak to trough. And once you do that, you can get a really good feel for, is it normally $10? Like, is that where it's been on average throughout the last 100 years? Is it $100? Is it $3? And if the historic average is $10 and right now it's trading for $3, cheap. If it's trading for $20, not cheap. And you can just take that and look at the S&P the exact same way. You can look at the Dow. I always look at the market cap to GDP, the Buffett indicator, if you will. I've mentioned that. I think I mentioned it pretty much on every video last week, because a lot of people, the buy the dip crowd, are saying that now the market's cheap because it's gone down by 20 or 30%. No, it's not. The market is nowhere near cheap. It's cheap to where it was 30 days ago, but that's like saying you got some 150 pound guy naturally that's juiced up on steroids, and because of the steroids, his weight goes to 250 pounds. And if he loses 10 or 20 pounds, is he healthy? Does he need to gain back that weight or recover the weight to get back to where he was? No, absolutely not. He's still got another 80 pounds to go before he's healthy again. So that's the way I'd look at it. Steven, thank you for the super chat. Did you know the cerveza sickness testing is active infections only? Antibody test may increase denominator. in mortality rate under. Yeah. So Stephen, what you've got to do is, I get it. I totally get it. And what you're trying to extrapolate there is you're trying to hope that we are already at herd immunity and we don't even know it. So herd immunity in the United States, call it 60% if the R naught value is 3, could be higher than that. That would mean 190 million people would need to have it. And what you're saying is that, well, maybe 190 million people have already had it, but we just don't have an antibody test. So we wouldn't know if they had it over the last 3 months, and they've recovered. Okay. If that's true, how is it overwhelming the hospital system in New York, in Spain, in Italy? If what you're saying was true, it wouldn't overwhelm a hospital system anywhere, because it truly would be, in fact, that mortality rate, that might even be less than the flu. So also, I hesitate there, because whenever they test a large group of people in like an Italian village or something, maybe 5%, 10% actually test positive. And I get it. Again, I totally get it. It's not an antibody test, which means that you could have had it 6 months ago or a month ago and it would not show up. I totally get that. But although I hope what you're saying is true, that would be amazing. I think the probability of that is extremely low, especially when you see what the steps that countries like China and Italy, Spain have taken to reduce the health impact. So if this was just a cold that we all had and just didn't know about it, and really no big deal, but it was just kind of being overhyped by the media, then would China really lock down their entire economy? Look at their PMI. Their PMI has completely tanked. They destroyed their economy. And if you look at the Communist Party, what is, like any political party, what is their number one priority? It's staying in power. Well, the way you stay in power is you make sure that the economy is functioning and moving forward. That's how you stay in power. So they were willing to potentially sacrifice their number one priority just to shut the economy down with draconian measures, to say the least. Would they do that if this was a common cold? Would Italy do that? Would Spain do that? I'm guessing no. So I think the takeaway from what I'm saying is I 100% hope you're right. 100%. I pray you're right. But I would not allow that to change what I am doing personally for myself and my family on a day-to-day basis. As an example, I wouldn't look at this and say, oh my gosh, so that's amazing news. And since it is most likely just a common cold, I'm not going to wear my face mask the next time I go to Costco. So I wouldn't do that, because I think that let's say the probability of this being true is 20%. If it's the probability of it not being true is 80%, then I think it's still wise to take the precautionary measures that everyone should be taking. Right, in my opinion, you should be taking. So hopefully, I totally respect your analysis. I think there's something to this, but I think you've got to weigh the probabilities there. Barry, thank you for the super chat. What is your perspective on commercial retail real estate? that is free of loans? Obviously, there will be high vacancy rate, but what's your long-term view? Well, my long-term view, it depends. I mean, you're saying commercial retail. That's a broad spectrum, Barry. I wish I could give you a more precise answer. I think just overall, I'm not really bullish on commercial real estate, retail, especially like low-end strip malls and whatnot. I don't. I think there might be an argument for like a super high-end luxury type mall, but short term, obviously, they're going to get hit pretty hard. But they do have the Fed buying their debt, most likely. I think there's a lot better opportunities out there. That's the best answer I can give you, Barry. Evgeny, hopefully I'm pronouncing that right. I apologize if I'm not. Hi, George. Very grateful for your educational videos and your crystal clean English. Yeah, I don't know about that. I think I stumble over my words probably more than anybody. But I thank you very much. I appreciate you saying that. You are from Moscow. Where is the bottom in markets? Sorry for the philosophical question. Wish you a lot of health. I wish you to be very super healthy as well, my friend. This is a really, really good question. Where the bottom in markets? I don't know. What I'm doing personally is I'm looking at where the bottoms were before, like 2008, 9, and I'm adjusting for inflation. That's my starting point. I'm not saying that's my conclusion, but that's my starting point. So let's just say the S&P got down to 1,000 at its low point. I know it was lower than that, but let's just say it's 1,000 in 2008, 9, whenever it hit its low. I would say I would type that into an inflation calculator, and they have them online. Just Google inflation calculator and just type in the date. So 2000, call it 8 to 2020, and 1,000 units would be how many units now adjusted for the CPI, for inflation. So let's say it's 1,500. Okay, well, that would be my starting point. 1,500 on the S&P. But to take it a step further, I'd only use that as like a macro analysis, and then I'd have to take it and look at the individual asset class or the individual stock and go through the process I discussed before in determining whether or not it's cheap. Looking at the oil as an example, $20 a barrel. Okay, you pull that up on a chart, you go all the way back, you can determine if that's cheap. So if the S&P goes down to, let's call it 1,500, where that's kind of my baseline, and I see that oil is trading at $10 a barrel, okay, listen, I don't care if the S&P goes down to 1,000. I don't care if that's not the bottom, not the top, not the bottom. I don't care at all, because the question becomes, is oil going to be more expensive? Is it going to be more than $10 a barrel in 10 years? For me, the answer is probably yes. A very high probability that it would be yes. So that means it's cheap. That means I'm going to buy it. And that's really I'm not going to say that's the extent of my analysis. I go into the balance sheets and look at debt and do all those things. But I think instead of asking yourself where the bottom of the market is, I try to look at it in a little different way. And then I would also look at the market cap to GDP. So go back to the early 80s. That's when it was definitely cheap. And your market cap to GDP was about 30 or 40%. So I do the same math on the S&P right now, or the Dow, or however they do that calculation, on how we get down. What would the number have to be on the Dow in order for us to be at like 50% market cap to GDP? That would be another awesome indicator that I would personally use. Joe, thank you for the super chat. Thank you for introducing us to Chris McIntosh. Yes, the guy's awesome, isn't he? Subscribe to his newsletter, which is awesome. Oh, great, Joe. I'm glad that you were able to subscribe and you're really enjoying it as much as I do. I know he's got a ton of these reports. I just actually read his report. I sent it to my sister on it's like a 12 or 13 page PDF that he did with his analysis of coal, not the ETF, but the actual material coal. And I really enjoyed it. Easy to read, but it's got tons of graphs and charts, and he really explains his thought process and why he's personally investing in it. So I'm really glad to hear that you're enjoying it. I'm struggling to buy into a dollar spike. Do you think it's likely? So if I understand you correctly, Joe, you're saying that you want to take Chris's advice and go long the dollar. And to be very clear, guys, because I know everyone in the chat's going to be like, what? How can you be bullish on the dollar? It's going to zero, and look at inflation, and gold's going to the moon. I totally get it, but we have to have the ability to have two completely separate thoughts in our minds and detach them and compartmentalize them, right? So even if you really listen to my interview with Chris, especially the end, you'll notice I keep pushing him on that. And hopefully you guys noticed me doing that, because I really wanted to explain how he could see a world where we have stagflation and go long the dollar. Because that's so counterintuitive. It seems like it's totally impossible. So I think he did a good job of that. I've tried to do that in every one of my videos. But so I just want to preface by saying that just because we're talking about going long the dollar doesn't mean that we think, or I think, or Chris think, or Brent Johnson for that matter, thinks we're not going to see inflation, consumer price inflation in the United States. So if you're talking about buying the dollar, see, the dollar, I don't know. It's hard for me to give you advice on this, Joe, because personally, I wouldn't buy the dollar. I totally get where Chris is coming from. And I'm not here to say that he's wrong. I'm just saying, for me personally, it's not a good fit. So, and I'm not saying that it's going to go down against the euro, or the DXY is going to 90 or 70. That's not what I'm saying. In fact, I would say it'll, well, I'm not going to give you an opinion on it, but my point is the way I personally invest is by asking what's cheap, right? And even with the speculation, and there, by no measure right now is the dollar cheap when you look at it historically. Now, maybe it's cheap compared to, because you're looking at the economies of the competing currencies, or because there's so much global debt that's denominated in dollars. I totally get it. But if you look at a chart, just old school, going back and compare how the dollar is not cheap right now. Look at the DXY. The dollar was at 70, for heaven's sakes, going back to just 2011, 2012. So it's relatively expensive. I'm not saying it's not going higher. I'm just saying that it's not a real good fit for me. And I think this is really important, guys, because if you watch Chris's video and at the end you're like, wow, I've got to subscribe to his newsletter, it's absolutely amazing. I think that's I think that's the emotion you're going to have. I think that's what you're going to be saying to yourself. But keep in mind that just because I think Chris is awesome and you guys are going to really gel with his investment philosophy, it doesn't mean that you just take every one of his recommendations and just buy that. That's not why I personally read research letters or newsletters. I do it because I want to absorb as much information as I can. I want to learn about the world around me. I want to understand how these professionals look at investing, speculation, how they look at money management, all these things. So I use it almost as much as education as anything else. And then what I do is I take their recommendations and I look at them thoroughly and I decide whether or not this recommendation is a good fit for me. And it might not be. I could totally agree with the rationale for why Chris, Brent, or anyone else thinks the dollar is going up, but it doesn't mean that it fits my personal strategy for my portfolio. So just to be clear, a lot of what Chris says, I completely agree with it. It makes a lot of sense for my portfolio, and I'm looking into it right now, but it doesn't mean that 100% does. So, and I think I would strongly encourage each of you, regardless of what newsletter you're reading or what type of content you're reading, you don't necessarily have to agree with the person 100%. It doesn't have to be 100% fit, but just take the pieces of it, cherry pick it, and then use it to build a stronger portfolio for yourself that's going to help you achieve your own objectives. The Argonautics, thank you for the super chat. Do you think that buying gold from things like Bullion Vault is a good idea? You have real gold, but they store it in Switzerland, England for you. My local alternatives are extremely pricey. This is a very difficult question to answer because it's so personal, and I don't know how much you're talking about. For me, I just, and this is different for everyone's comfort zone as well. I just, the more physical gold you can have, as long as you're comfortable, I think that's always better because you're buying it as insurance. Now, I understand you're not going to have, 300 grand worth of gold sitting in your sock drawer. But if you got like 10 grand or something, I would much rather have 10 grand just buried in my backyard than I would being held in Switzerland or England. And even if it's a little higher price, because I'm not buying gold to make money, I'm just buying it whenever I have an additional chunk of money. Let's say I sell a piece of real estate and I make $100,000 US. I just take 10% of that and I'm going to buy gold with it. If the price is 1,600, I'm going to buy gold. If it's 16,000, I'm going to buy gold. If it's 600, I'm going to buy gold. It doesn't matter. And so that's kind of how I do it. So to be clear, I like physical in your backyard or wherever, as close as to you as possible. But if you get to a point where you're not comfortable having that much, then I think storage is obviously a good alternative. I would just make sure that whomever you're storing it with is reputable, and maybe like a mint, or I'd also like to store it maybe different jurisdictions so you don't have a lot of political risk, and also preferably in a country that hasn't confiscated gold in the past. That would be my best advice. Jonathan, thank you for the super chat. George, do you believe it's possible the safe haven view of the United States dollar ultimately tempers inflation. I don't see the view disappearing anytime soon. In my opinion, it all depends on your time horizon, Jonathan. I think there's a valid argument, like I've said many times on just this live stream, for the dollar going up against other currencies. Very important. I think there's a great argument for that in the short term. In the long term, call it 5 years, 10 years. I don't see that happening. I don't see it happening. So what I'm saying is it really depends on your time horizon. And although personally, over the next year or two, I can totally see the DXY being higher than it is, in 5 years or 10 years especially, I can't see that. Not to say it won't happen. And there's no certainties at all. I would just say the probabilities, in my opinion, are low that the DXY would be higher in 5 or 10 years than it is now. Ellie, thank you for the super chat. How can the Treasury spend unlimited money without loaning it? Oh, without loaning it from the Fed, without borrowing it from the Fed, maybe? Like maybe borrowing it. Like Brent says, spending it into existence. Okay, so Brent's just, what he's doing, that's a great question. And Brent's just kind of quickly connecting dots in his head and assuming that you guys will just connect those dots. And if you're not connecting those dots, it doesn't mean that you're not super, super intelligent. It's just when you get into the world of economics or finance or the Fed, it's got its own different language. And it's just like anything you guys do. If you're a lawyer, if you're a dentist, if you're a school teacher, within your industry, you have your own type of lingo. And if someone is an outsider looking in and they don't have the same lingo, then they're, what are you talking about? So what Brent's saying is that the Treasury is going to spend money. Well, actually, I got to remember our conversation. I think he was talking about two separate things. So number one, if you're talking about the way the system is set up now, the Treasury would spend money into existence by issuing a bond. The Fed comes in and monetizes the debt. So they buy the bond or the Treasury to keep interest rates low. The Fed has created additional reserves. And if those reserves are going to the TGA, which is the Treasury General Account, then new money has been created. The Treasury spends the money from the TGA account. It goes out into the economy. It creates additional deposits. And therefore, in a sense, the Treasury is spending money into existence. I think he also talked about a new way moving forward where, and this is more of the MMT crowd, where they say it would be better to kind of eliminate the Fed because you don't really need the Fed, and the Treasury would just create its own currency. Like they would be, as long as they just, there would be really no need for the government to take on debt or to sell debt or to have interest payments, because the Treasury would effectively have the power of the Fed. And when the Treasury had the power, they wouldn't be creating bank reserves. They would actually be creating additional deposits in the real economy. So they would be directly affecting the money supply, not just base money, but broad money. And so Brent's talking about two separate things there. Number one, how it is today, and he's maybe just connecting the dots. Number two, if we moved into an MMT type of world, and from what I understand with MMT, there wouldn't really be a need for the Federal Reserve at all. There would be no need to sell debt, because the Treasury would just create money, just like Brent was saying, by just spending it into existence. Meaning, if they want to buy $1 trillion worth of airplanes from Boeing, as an example, the Treasury would just go to their computer and go and say, or they'd say, Boeing, who do you bank with? And Boeing would say, Wells Fargo. Okay. And give me your account. It'd just be like wiring money. And they'd be like, give me your account, your routing. And they say, okay, Treasury, here it is. And the Treasury just goes, and then bam, hit send. $1 trillion is in Boeing's account. That's how, and there's no debt that's sold at all. So the Treasury would be doing exactly what the Fed is doing now. But instead of just creating bank reserves, again, they're creating deposits in the real economy. Hopefully that makes sense. and it's actually really hard to explain that without a whiteboard behind me. But hopefully that's clear. Stacy, thank you for the super chat. Won't there be people who will accept gold directly rather than having to sell gold? Maybe. There could be, Stacy. I don't know that that's the most probable outcome. Just because and I hate to say this because it's just a nightmare. But I do think there's a good chance that the developed economies, the United States, goes to a digital government-backed currency, in which case they might not ban gold, but they would definitely ban using gold to transact. The only way, unless you just had a buddy and you said, hey, I'll trade you some gold for your Xbox or whatever, then they're not going to, I don't think they'd have any ability there. But if you went down to the local grocer or car dealer or something, I don't think it would be legal to give them gold, regardless of even if they were down with it. I think if you had a corporation or an LLC or any type of business entity set up, you would be required to only do business with the government-backed currency. I think that's, and again, no certainties. That's just in my mind when I'm thinking through this out loud. That's what I see being most likely. Conrad, thank you for the super chat. Do you think the U.S. will reprice silver higher? I haven't thought about that, Conrad. I know they definitely could gold if we get to a point where the whole entire world has lost confidence in fiat money and we want to go back, or the governments have no other choice but to instill confidence in a currency by backing it with something real like gold. We may get there. Do they choose gold or silver? I don't know. I know if they chose gold, then you have to reprice it. You'd have to reprice silver based on the money supply. I would say probably gold, though, because silver, if you guys watched my interview with Rick Rule, he pointed out something I had no idea, that there's only a very few pure silver miners. Most of the silver that's created is or mined is a result of mining something else. And then, oh, by the way, oh, look, there's some silver right there. Let's go ahead and grab it. So it's a result of mining something, some other mineral or material. Where gold, of course, there's more pure gold mines to where you could have most likely an increasing amount of it, or that would be more predictable, the supply. But yes, if they go to a silver standard, then they would have to adjust the price of silver so they wouldn't affect the money supply. So I guess that's my quick answer. 1TS, thank you for the super chat. Hey, George, I've saved about, wow, 120K. Good for you. Awesome. Great to hear that. Over many years to buy a house in the Bay Area. Oh, man. Eesh. Okay. 2 questions. Will the increased unemployment cause a downturn? This is a great question. Wow, this is a good question. Okay, so let me go back here a little bit. And no, that's not stiff drink time. That's my bottle of water. That's not a stiff drink. I'm not reading the live stream, but I know that's what's going through everybody's mind right now. Is, oh boy, George is so negative on the real estate market in San Francisco. It's stiff drink time. No, not at all. Just water. Okay. So, will the increased unemployment cause a downturn in housing prices in the Bay Area? How do I protect my purchasing power? The reason this is such a great question is because we have to look at the source of income for the Bay Area in general, or Silicon Valley. That comes from a lot of tech companies that don't make profit. To be clear, a lot of them are fantastic companies that make boatloads of profit, like Google. But that's not the majority. The majority are the Ubers or the Lyft, others, but something in that category. So if we have a downturn in the economy and money gets tight and the spreads in the junk bond market blow up, meaning the interest rates in the junk bond market go sky high, call it 10, 15%, if not higher. How does that work for an Uber that has had quarters where they've lost over $4.5 billion in one quarter? And that's not when they were just a startup. That was last year, if my memory serves me well. So my point is, it's going to be a lot harder for these companies to access the capital they need to stay afloat, especially if we go into like a 2-year bear market. So if the majority of the income and purchasing power in the Bay Area is a result of these companies having access to cheap money, free money, just massive amounts of liquidity just raining down on them from funds like SoftBank and everything like that, like WeWork, then if we go through a housing downturn, which I think we probably will, not overnight, because housing takes a long time. It's like a giant Titanic that well, maybe Titanic's not the right word, but it's like a giant ship, and that you can't just turn it on a dime really quick, because you've got a big discrepancy between sellers and buyers. I think Jason Hartman, my buddy, said it the best. He said sellers are always looking in the rear view mirror and buyers are always looking straight through the windshield. So they're always looking at the past, they're always looking at the future. A lot of times it takes a long time for them to meet in the middle. But if we see a decline in housing, it's going to hit, in my opinion, it's going to hit the Bay Area maybe the worst of any city in the United States or any metro. I'm trying to think of one that maybe hurt worse. Maybe New York, but it's going to take a dive. And so that's what will cause. So yes is my first answer. Will the increased unemployment cause a downturn in housing? Yes, that's my first answer. And to be clear, it'll most likely be more dramatic than it would be in other places in the United States. How do I protect my purchasing power? So that would pretty much be, make sure you've got gold, like we've been saying, 10% of your portfolio. I would have some dry powder in the form of T-bills. I know they're negative right now. Ugh, I hate to say that. It depends on how much. Well, 120. Okay. So if you got 120, you've got a very small community bank where you trust them quite a bit, and you know that they keep all their debt on their own books, and they did extremely well during the GFC. I'd be okay with 120 in that account because it's going to be FDIC insured. Not that I'm a big fan of the FDIC. I've been very critical of them in my videos because they've only got about 100 billion, maybe 140 against 10 trillion in deposits. But I do think that they would most likely be bailed out, especially if the Fed and the government, especially if they're bailing out literally everyone. I mean, every corporation, MMT, you name it, everybody's getting a bailout. So I would think that the FDIC would be at the top of that list. So protecting your purchasing power, I'd probably do it in T-bills. If they were negative, I'd probably just put it in the bank. Not in a CD or a money market, just in a checking account. Aurora, thank you for the super chat. Hello, George. Thank you and your team for your channel. What do you think about potential gold confiscation and what to do in that case? And does it make a difference between bars and coins? No. Well, actually, maybe it does. I've heard in some places, I can't remember if it's the UK, but there was a type of coin that you could buy that they considered actual money, and therefore they didn't confiscate it. And I'm don't quote me on that because I'm going right off the top of my head. I think if you're concerned about confiscation, gold bars are going to have the biggest target on their back. That's for sure. So if you're super concerned with it and you've got a lot, I'd consider multiple jurisdictions. I would consider jewelry. But even if you were worried about confiscation, I'd still keep some within walking distance or a bike ride just in case it really hits the fan. That's probably the best advice I can give you. Joe, thank you for the super chat. Thanks for introducing us to Chris and Brent. Yeah. Smart money guys, and both see USD spike in the coming months. Do you agree? Feels counterintuitive after massive money printing by the Fed. It's a great question, Joe. And I've addressed this a lot in my videos this week and in interviews that I've done for other people. And I've on this live stream. So I'm going to say it just really quickly to reiterate, just in case you didn't have the chance to hear it. But I think you have to compartmentalize your bullishness or bearishness on the dollar. So, Joe, if you're asking me if I'm bullish or bearish on the dollar, let's say in the next 6 months, I would have to ask you compared to what? Compared to my groceries that I buy at the supermarket, I am very, very bearish on the dollar. Super bearish. Compared to stocks, I'm pretty bullish on the dollar. Compared to Oil over 6 months, I'm kind of indifferent. Oil over 5 years, I'm very bearish on the dollar. Gold, I'm very bearish on the dollar. A basket of currencies, including a basket of currencies that has over 50% euros in it, pretty bullish on the dollar. You see, that's how I really want to encourage every one of you. What, we got 1,600 people watching me right now. Jeez, that's pretty crazy right there in and of itself. But for all 1,600 of you watching, that's how I want you to think about it. And if that didn't make sense, when we get done with the live stream, go right back. We're at the hour 30-minute mark, and just listen to how I walked through that. And if you can start to visualize and think about the dollar in those terms, I think you're going to be much, much better off over the next 6 months and the next 10 years. XRP, bull on the moon, $20. Thank you. And the reason I mentioned that is because he says, no question, this is for Sebastian. For doing a great job supporting you and the channel. Thank you very much, XRP. Thank you very much for Sebastian. Everyone give Sebastian a big round of applause in the live chat. He doesn't have to do this. It's on his day off. He's at home, and he's still here managing the chat, managing the super chats. So we all need to be very grateful for Sebastian. If he wasn't here, I really couldn't be doing this with this many people on at one time, because the thing moves so quickly. So Sebastian, remind me that when we do get back to normal and you come into the office, remind me to give you a $20 US bill, USD. I'll do that for XRP, bull on the moon. Shady says, or thank you for the super chat. Says, big fan of the show. The guests you bring. Thoughts on using tips as a hedge against inflation. And tips. Okay. And also he says, P.S. acute care PT at Columbia in New York. Tell everyone masks on outdoors in big cities. Let me answer the first part of your question, Shady, because I'm not really totally understanding the PS part. But let me start there. So tips are inflation-adjusted treasuries. I would say, yeah, well, see, first of all, I haven't really looked into tips for myself or any of my family members, so I don't know what the maturity is. I don't know if you can buy them like 6 months, 3 months, or is it a minimum 3 years, 10 years? I don't know. So that's where I'd start, because I don't care if it's inflation adjusted. I still would not want to own anything over 6 months. Number one, because I want the dry powder, and I don't want to have to be forced to sell after 3 months if I find an opportunity that's better. Also, I think even if it's adjusted for inflation, it's going to be adjusted for the government's inflation. And we all know that that's totally bogus. So you could still be losing purchasing power by buying tips, even if they're going up with the rate of inflation, because they're going up at 2% because it's the government inflation, when in reality, inflation is going up at 5%, and you're losing the spread in purchasing power compounded. So maybe maybe for something over the 6 months or less, or maybe a year or less, but I wouldn't get into it for anything more than that. Okay, going on to the next part of your question, acute care. I'm not sure. You're saying acute care at Columbia in New York. Please tell everyone masks on outdoors in big cities. It's bad. Oh, I see. So you're saying that the cerveza sickness is getting bad in New York City. So hopefully Columbia is telling everyone to wear masks, and you're saying, yeah, guys, please let's come on and let's wear masks when we're outside. I think that's what you're saying. And if so, I definitely agree. Don, thank you for the super chat. Do you think the world central banks will liquidate holdings of USD assets bonds, especially China, Japan, and will this affect the dollar, the value of the USD? I think that's a strong argument, Don. Also, because they may have to liquidate. I could see an environment where they're trying to sell all their USD assets because they see inflation rising in the United States and they don't want to be the one holding the bag if they've got a 10-year treasury and get paid back dollars that are worth half as much. So long term, I definitely think that's a possibility. But short term, even if the dollar is strong against other currencies, they may have to liquidate because they need the money. They need the cash, especially China, because China's got to keep their peg. And they need dollars to do that. So if they get short on dollars that they would need to defend their peg, they would have to start selling dollar assets. Now, I have not done the math. I'm sure Kyle Bass has. So as soon as we get done this video, I would try to look up some of Kyle Bass or some Kyle Bass videos on YouTube to get his take on this. And I mean, he's one smart dude, 1,000 times smarter than I'll ever be. And not only that, but he's got a fleet of people that do this type of research. So my answer, Don, is I see where you're coming from. I think it is very likely longer term when we do start to see the dollar go down against other currencies, that meaning 3 years plus, maybe less. But I think they may have to do that in the short term just to come up with dollars they need to pay their debts or peg their currency. And if they do that, then yes, you are right. That would create more supply of dollars. And then it's just a matter of if the additional supply of dollars is outweighing the additional demand for dollars. Marcos, thank you for the super chat. Is there a possibility with all this fake money printing, the dollar could be replaced as a standard currency? Other countries have to actually produce to get dollars. US just has to print. You got it, Marcos. You got it. Hit the nail on the head. Other countries have to produce. The United States hasn't been in that situation for a long time. So they have been able to consume a lot more than they produce. They have lived above their means. That's just a simple fact. I do think the dollar could be replaced as the reserve currency. I don't think that's going to happen in the next year or even 3 years. there's so many factors that go into that. So long term, 5 years, 10 years, yeah, I see that being a possibility for sure, but not in the short term. Steve, thank you for the super chat. Hi, George. Thanks for the content. What about Plaza Accord 2.0 with Brent Johnson? What will I think, okay, so let me reread this. I think we might have some typos here. and trust me, guys, doing this on the fly, it ain't easy. This is actually pretty tough to do this, but I really enjoy it. I really get a kick out of it. We still got 1,600 people on the stream. I know we're going way late here, but I really enjoy it. So thank you for your time, guys. Thank you for spending part of your Sunday with me. But let me reread this. Hi, George. Thanks for the content. What about the Plaza Accord 2.0 with Brent Johnson? What will happen in emerging markets like Southeast Asia? Steve, it really depends on which country you're referring to and how much dollar-denominated debt they have. If they don't have much, and also if they produce oil, because that's a way for them to make dollars to pay off that debt. Although the amount of dollars that they're getting now is dramatically reduced because the demand for oil is down, the price down as well. So it'd be harder for them to make those payments. But if they don't have oil coming in at all, they have no dollars coming in other than what may be coming in through tourism or something, or maybe their exports. It puts them into a position where they've got to print some of their own currency, which devalues it. But again, it goes back to how much dollar-denominated debt they have. If they don't have any dollar-denominated debt, then it's kind of a moot issue. Then it would just be a matter of their imports and exports relative to the dollar. So if their currency was going down, then of course that would give a little bit of tailwind to their exports. It hurt the imports and vice versa. But a lot of emerging economies have a big problem. And I think where you're going with this is if the dollar gets up to, and I'm using the DXY, gets up to 110, 120, 130, 140, it becomes almost impossible for these countries to service the debt, the dollar-denominated debt they have. Not only the countries, but the corporations and entities in the private sector outside of the United States. A lot or most of the borrowing outside the U.S. for big corporations is done in dollars, or a lot of it. So that would be a huge problem. To your point, Steve, and to Brent's point, it would get to a level where the world just could not handle the dollar at 140. It would just be crushing every country. And that would have a serious negative impact on the United States as well. So they get together, they decide, listen, we have to devalue the dollar. Now, some people may be all for that, people meaning countries. Some may not. So I don't know that you'd have a coordinated effort like you did in Plaza Accord 1.0. But I think, and from my studies, what might happen is the Fed would just say, listen, we're printing up $1 trillion and those are reserves. I don't know how they would get the reserves into I guess they could do it through the primary dealers. They could probably do that through the primary dealers. I'm just trying to think through how they would get the money into the outside of the United States. But that's probably it. So anyway, they'd figure out a way to do it. They'd print up $1 trillion, boop, or maybe more, 5 trillion, 10 trillion, and they'd get it outside the United States in the global economy, and that creates as much supply of dollars as needed to bring down the DXY to 110 or something that's manageable. So that would be an artificial devaluation of the dollar. And I think that's If the dollar gets that high, I think that's the only way out. So I totally agree with Brent that, again, if the dollar goes that high, I'm not saying that it is. I see just as good of an argument for the dollar going down to 90 or 80 than up to 110, 120. But I don't see how the world survives at that level. Keith. Yeah, good. Great comment, Keith. You got it, buddy. He says, if you ever need physical gold, then you also need ammo and cardio. That's good. I like that. Definitely true. Or maybe a fantastic bicycle. Yeah. Greg, thank you for the super chat. Hello, George. Hello again, George. Thank you to thank you to Infinity. Yes, I'm getting a Buzz Lightyear. Thank you from Greg. Thank you for your insights and wisdom. For those who wish to own gold, how do you feel about the GLD? No. No, I don't like the GLD. I don't like it because your custodian's HSBC, and I don't like HSBC. If you're just doing it as like a 1 week trade or something, I get it, but I would rather have physical. And if you can't have physical, like let me give you an example. Like right now, I'm in Colombia. I'm quarantined, so it's not like I can just go down to the local store or have gold delivered. So I needed, just for the balancing of the portfolio that I preach to you guys on a daily basis, I needed to get some exposure to gold. I don't have any choice. I have to buy an ETF. I don't have a choice. So now, that, to be very, very clear, guys, I'm not suggesting that to do that. I don't like ETFs. Other than, now with equities, it's a different story. I'm just talking about pure physical gold or silver. So what I did as a solution is I bought, what was the ticker? PHYS, I think is the ticker. That's Rick Rule's Sprots ETF that they have for physical gold. I did the research, and not only do I trust Rick a lot, but I did the research, and their custodian is the Canadian Mint. And if I have to trust a counterparty, I would much prefer to trust the Canadian Mint than HSBC. or the Canadian Mint is where it's stored. I'm not sure they're the custodian, but that's where it's stored. They're part of they're the main hub in the supply chain there. So, or the storage chain, if you want to look at it that way. Now, to be clear, as soon as the dust settles and the cerveza sickness is in the rear view mirror, I'm going to most likely sell my the shares of PHYS, I think, but whatever Sprot's physical gold product is, I'm going to sell that to buy the physical. But just for the time being, that's what I'm doing. Satish, thank you for your super chats. And guys, we got to cut off the super chats because I got to let Sebastian go. He's very generous with his time, but I've got to do some research. I've got to look at a ton of things. I got to eat lunch. A lot of things are on the agenda. So no more super chats. So range 2300 will be the last one, Sebastian. Yeah, no more super chats. Yep. Thanks, Sebastian. So Satish, I'm not sure if U.S. can have consumer inflation while dollar rises. Wouldn't the market resolve the tension by importing cheap goods from outside? Yeah, but Satish, you're assuming that we can get those, or we're importing, right? So if we have supply chain disruption, we're not going to be importing as much. And if we also have a huge push, we meaning the United States, towards deglobalization, which I think is what's going to one thing that's going to be a net result of this whole issue, because I think the politicians are going to say no more medical masks coming from China, no more pharmaceuticals coming from India, none of that. We've got to start producing all that right here in the good old US of A. So if we have another issue, or if the cerveza sickness comes back in the fall, or we go through another wave, that we are prepared and we don't have to rely on any other countries for the necessities that we need in the United States. I think that's going to be the narrative. And I'm not saying it's good or bad. I just think that's going to be the political push. Therefore, you're going to have a lot fewer imports. Therefore, the input costs are going to go up, which is going to create inflation. And you're not going to have a transfer mechanism for those dollars to get outside of the United States. So if there's fewer dollars getting outside of the United States, that means less supply, DXY goes up. If there's more dollars in the United States, and there's fewer amount of goods and services, and the goods and services that are in the United States are being created and manufactured at a higher price, bingo, there you go. That's what gives you the consumer price inflation inside the United States, and that's how you get the DXY going up outside the United States. But Satish, to be very clear, I love the way you're thinking about it. You're really trying to peel back the layers of the onion, and I think that that's fantastic. And to be clear, you could be right. I think I'm not saying you're wrong. I'm just saying that from my vantage point, I see it a little differently as far as the probabilities. Greg, thank you for the super chat. What percentage per year since 2009 would you say corporate buybacks impacted equities? Wouldn't that be the start of yeah, that's a good point. That's a good point, Greg. So Greg is asking, if you go back to 2009, if you look at the increase of the S&P that was directly due to corporations buying their share backs, assuming that that had to kind of deflate and that malinvestment had to get out of the system, that takes us down to a starting point for the market. I'd also adjust for inflation too. According to most of the charts I have, Greg, and I've seen, and the charts I've seen Raoul Pal use on Real Vision, since 2010, almost 100%. Like we're talking 90% of the increase in the S&P 500 has been a direct result of corporations buying their shares back. Those are the charts I've seen. I've seen other things that say it's maybe 50% or so, but it's a lot. Let's just say that it's 50%. So that means we have to, that would, from the highs, we go back down to 15,000. And from 15,000, you adjust for inflation, and it takes you down to 12, something like that on the Dow. I'd have to just work the math on the S&P. But I think just like the super chat before with Satish, Greg, I really think you're peeling back the layers of the onion, and you're looking at this as a multi-dimensional puzzle and trying to ask, okay, what's next? What are the knock-on effects? So the bottom line, I think you're really you're thinking about this the right way. I think that's great. Andy, thank you for the super chat. Hi, George. Is the Fed now poised to directly buy junk debt via one of their new acronyms? If so, seems shorting junk is no longer a play. There we go. We got 3 in a row. All the super chats today are fantastic, and you guys are really putting your thinking cap on. But Andy, absolutely. You're looking at the knock-on effects, and the Fed has come up. What did I do in the video the other day? It was like 8 or 9, maybe 7 of these acronyms, abbreviations, 4-letter solutions, whatever you want to call them. when it was just the primary dealer credit facility, I thought they'd do it that way, that they just have the primary dealers go into the market, buy with the 1.5 in excess reserves. Once they're on the balance sheet of the primary dealers, the Fed just gives them a loan that they really don't have to pay back. They just roll over at 0% interest, and then just moves the junk debt from the primary dealer balance sheet to the balance sheet of the Fed. But I guess that would require them relying on the primary dealers. They didn't want to do that, so they came up with another one of these acronyms to where they can. I'm not sure if they're buying junk debt directly yet. I think they will. If my memory serves me right, and I can't remember if it was TALF or I can't remember what stupid abbreviation it was, but it's a great point that at some time over the next 3 months, 6 months, I think the Fed is going to try to get as much of the private sector balance sheet onto their balance sheet as possible, because once it's on their balance sheet, it doesn't matter if it takes a 50% haircut, a 80% haircut, doesn't matter, because the Fed doesn't have a P&L. Where if those assets took a 50% haircut on the balance sheet of the private sector, we would have big problems. So to answer your question, yes, I don't know that shorting JNK is a good idea because of the Fed backstop. I think there's other ideas out there that have a lot more, not only more asymmetry, but have a lot less downside. John, thank you for the super chat. Which tanker? Brochacho? Is that a tanker? TK, NAT, ETF. You're the man. Hope you come into $6 trillion of MILF. That's funny. Yes, that crazy acronym they came up with. What a joke. You got 900 PhDs and no one raised their hand and said, hey, Jerome, do we really want to go with MILF? I don't know. What I'm looking at, John, is just the ETF. I haven't had time to go into Chris's research, again, Chris McIntosh, to find out which individual names he likes the best. So if you subscribed to the deal that Chris's team was offering through our affiliate link, and that's in the description of the full-length video I did with Chris, then I would dive into that further to get Chris's recommendations on specific tickers. What I did, just because I didn't have much time, is I just the other night I looked at the ETF, which is, I think it's TK is the ETF, and just tried to get a good idea of looking at that chart to see if it's cheap, and if so, and what the PEs are, and just try to get what the dividend is. Doesn't really have a dividend. So for me, it would be more of a speculation. But that's what I was looking at personally. But I really like that play, the tanker play, because if oil goes down, most likely the prices will be driven up. The demand for tankers will dramatically increase. And if the price goes way up, then it's a home run. So the only way you kind of lose is if oil only goes up maybe $10. And I think over the long term, if you're like me and you're holding it for 3 years, 5 years, 10 years, that you could do very well. Or you're holding it until it gets expensive. I think for me, with a speculation like that, I wouldn't necessarily hold it for 10 years because I'm not getting paid to own it. I would just say, I'd look at a chart and say, okay, is it expensive now? And if so, that's when I'd unload it. Zoomer, thank you for the super chat. Hi, George. Don't you think a great opportunity to buy stocks as USA will come out of this stronger? New World Order will have to be U.S. in the driver's seat. China sanctioned. Again, Zoomer, it's not cheap if you're just talking about the broad market. So I only, just because something's come down, again, if a guy is 250 pounds because he's been taking steroids and he comes down to 230 pounds, that's a dramatic decrease in his weight, but it doesn't necessarily mean he's healthy, right? If his original weight or his natural weight is 150 pounds, he's not healthy just because he's gone from 250 down to 230. So that's how I see the stock market right now. And to be clear, if you're talking about specific sectors or specific stocks, then it's different. Like, obviously, from what I've said here, with oil, coal, these tankers, I think there are some opportunities out there where there's sectors that are cheap. But if you're just talking about the S&P, I do not think it's a great opportunity yet. I think it will be. I think, and this is really too precise to predict, but if I had to guess, I think we're going to see the market going lower into the end of April, I think, because that's when hopefully we'll be at a peak, and then we'll start to see the cases level off in the States. And not that we're in the clear, but I think the market will price that in and maybe start to go up. But also, Zoomer, see, what you're doing here is you're assuming that, number one, we had a solid economy before. You're also assuming that everything that worked to get the economy back, or you're assuming everything that worked to get the Dow to 30,000 still works today. And I don't think that's true. Look at the Fed put. It could be expired. They come out with trillions. I mean, 125 billion a day in quantitative easing. That's it. They've got no more bazookas. They're out of ammo. And the market goes up for an hour and then comes crashing down. We're down by 2,000 or whatever it was that day. So if the whole reason we got to 30,000 on the Dow wasn't because of fundamentals. Let's be very clear. It was because of liquidity. It was because of the Fed. It was because of artificially low interest rates. It was because those artificially low interest rates pushed pension funds further out the risk curve. Those pension funds gave all their money to corporations that took the money, levered up, and then bought their own shares back. So in order for us to get back to that level, we would have to have those same elements in the mix. Or your argument would have to be the fundamentals would have to improve so dramatically with the U.S. economy that would take us to 30,000, meaning we would have, for the next 3 years, we'd have to grow at, like, call it 5%, probably more, call it 6-7% real GDP. So I don't think anyone on this chat right now would have a lot of confidence in that coming to fruition, to say the least. So just the takeaway here, Zoomer, is I totally get what you're saying, but I just don't see how we get back to 30,000, because the stuff that worked and got us there from 2010 to 2020, I think now are off the table. And now we're back to relying on fundamentals driving the stock market. And I don't think the fundamentals warrant a 30 PE or a 30 on the CAPE ratio or market cap to GDP being 150%. Okay, range 2,300. Thank you for the super chat. Says Comex stopped sending gold to their ETF clients. I'm not sure if that's a question or if that happened. I'm not sure. Well, what I do know is it just goes back to what I've been saying is as much physical gold as you feel comfortable storing within a bike ride, assuming your cardio is good. Assuming your cardio is good or you got a really awesome motor scooter. But that's, to me, that's optimal. That's the best way to go about it, to where you don't have any counterparty risk. With any ETF, you're going to be taking a little bit of counterparty risk there. So, and I think you're talking about the demand or the supply demand imbalance for physical right now being so out of whack, and it's just, I think you should avoid at ETFs if you can. Go for the physical. If you feel uncomfortable with that much storage, try to store it in places that are secure, safe, diversify your political risk, maybe get some jewelry. And for me, what I'm doing personally, if I 100% have to invest in an ETF that's gold backed, because I have no other choice. For me, and I'm not saying this is right for everybody, this is not investment advice, but I like to do it with Rick. That's what I do. Okay, and Steven, thank you for the super sticker. We got a fist bump. All right, Steven, right back at you, my friend. So thanks, guys. I want to remind everyone to check out that Chris McIntosh interview right now. If you haven't seen it, you're going to love it. You can see how much positive feedback we're just getting in the chat stream. And if you guys are interested in his research, make sure you check it out through our affiliate link. It's a great way to get a smoking deal on Chris's research, some amazing opportunities, suggestions, investment ideas, and it's a great way to support the channel. Guys, just like Sebastian. So check that out right now. Check out the podcast. Go to the email list, subscribe. I'm going to be doing another video that we'll upload there soon, and I will see you on the next video. Thanks a lot, guys.